听见资本本期视频为您带来的是加拿大全球投资研究公司阿尔派宏观在3月5日英文网络会议的关键内容。市场正在与特朗普总统和鲍威尔主席上演一场惊心动魄的胆小鬼游戏。这场博弈直接牵动了我们的钱袋子。股市最近的表现简直就是在呐喊，我们对增长前景有点慌啊！尤其是在政策不确定性这么大的情况下，事情可能随时翻天覆地。我们来聊聊几个关键点。首先，这是一场实打实的增长恐慌，地缘政治紧张、关税压力、财政阻力，桩桩件件都让市场绷紧了神经。其次，这种恐慌可能有点过头了。分析师指出，尽管表面数据晃动，但企业盈利这块基本面依然稳如磐石。最后，眼下稍微转向防御策略是个聪明选择。国内的公用事业、房地产、部分医疗保健板块值得关注，同时别忘了保留科技领域的进攻火力，以防市场突然反扑。再看看市场情绪和技术面，投资者现在悲观得不得了，仓位像是被大甩卖了一样，期权市场的下行保护成本也在蹭蹭上涨，这说明大家对风险的态度相当严肃。不过历史上每次投资者这么低落时，反而可能是转机的信号。基本面这边，企业盈利没掉链子，甚至还在稳步扩大，尤其是小盘股和价值股的表现让人眼前一亮。只要盈利不崩，熊市就不太容易冒头。最近的新闻和社交媒体也在热议特朗普的贸易政策、鲍威尔的利率动向，还有中美贸易战等地缘政治话题，这些都加剧了市场的不安。但如果这种增长恐慌只是短期的，市场说不定会迎来一波反弹，就像去年夏天那样。现在分析师的看法是，在这场胆小鬼游戏里，政策或许需要点转变来解围。与此同时，调整一下投资组合，稍微偏向国内防御性领域，减点周期性敞口，可能是个稳妥的应对之道。如果您需要我的投研助理人工校对的英文原稿与中文翻译，您可以在频道的 Patreon 上获取。接下来是英文会议的全部内容。
Well, we hope everyone's buckled up because the market's playing a major game of chicken with President Trump and Chair Powell, and we're all here for the ride. Equities are clearly communicating distrust with the growth outlook, especially within the context of policy headwinds. You have this level of uncertainty, you add in some richly priced risk assets, well, things can go boom in the night. 3 points we make overall. First, this is clearly a growth scare where bad news is being treated like bad news, and it's being exacerbated by geopolitical and fiscal headwinds that the market's taking very seriously. Second point we'd make is that we do think the scare is overstated given idiosyncrasies that likely affected some of the data. So, until proven otherwise, we view the fundamental backdrop as solid, especially within the context of corporate earnings. And our third and final point is that a slight shift, even temporarily, to what we call a counteroffensive game plan is prudent. We still think equities are biased higher over the intermediate term, but risks have risen, and the tape speaks for itself. So it does make sense to bolster some elements of domestic defense, which include utilities, real estates, even parts of healthcare, but you want to retain enough offensive firepower in the tech space for when the bulls punch back. Let's dig into the chart pack. All the evidence you need that equities are succumbing to a growth scares in the chart showing the 10-year treasury moving lower alongside economic momentum. And then you have the correlation between stock returns and yields, which is spiking higher. That's what's happening. Now, a few months ago, if you were told that the 10-year treasury would keep moving lower, you probably would have suspected that inflation was cooling and considered that a boost to cyclical segments like home builders or small caps. Hasn't been the case this time at all. And that's, of course, because it's growth that's bubbled up as the main concern, as opposed to inflation. Now, the actual hard economic data is still firm for the most part, but it's just soft data that's raising eyebrows. So the real risk is in businesses and consumers talking themselves into a recession, sort of a self-fulfilling prophecy. And now one of the reasons why sentiment is bombing out in the first place is this front-loaded cram down of populist policy, whether it be DOGE, immigration, of course, tariffs. You're getting the policy spinach up front as opposed to what we praised the policy candy in the form of deregulation, tax reform, all that good stuff that got investors jazzed up in November. What we're showing here is that the market and sentiment is responding to tariff risks in a big way, with companies and industries with the most domestic exposure, those that are more insulated from tariffs, outpacing those with the least domestic exposure. Another way we look at this is through the experience of 2018 and 19, or that first trade war. What you see here, equities had a major sell-off, and it corresponded with an increase in tariffs, mostly directed at China. That being said, it also corresponded with rate hikes, so we can't attribute the entire market reaction to tariffs. But it's important to note, earnings did decline. So there was a tangible, fundamental catalyst for that sell-off. And as you see, the impact of that setup had varying effects on fundamentals across sectors, sizes, and styles. Now, generally, large domestic defensives did do better. Tech did well itself. Now, obviously, investors will be better served if earnings don't decline this time around. However, we do need to protect ourselves at that risk. From a market standpoint, you're seeing historic levels of fear or bearishness pop up. On the left side, you can see here, investor sentiment has rarely been so bearish following a period of decent gains. It's quite incredible. Now, historically, when investors are, we actually have the slides messed up. Now, positioning is starting to look a bit washed out. If you're looking for a bear market, you really don't have to go far. You'll see that the average stock in 7 sectors trades 15% or more off their 52-week highs. So you really have corrections, you have bear markets all over the place. Blood has been shed. And on a technical basis, you can see more stocks are appearing washed out. And finally, on the right side, we highlight here, the cost for downside protection from options is also moving higher. Now that provides a proof point that investors are taking these risks seriously. As it relates to sentiment, you're really seeing historic levels of fear or bearishness pop up. On the left side, what you see here, investor sentiment for retail investors, it's rarely been so bearish following periods of decent gains. It's quite incredible. Now, historically, when investors are this bearish in these conditions, it's actually a good contrarian signal. Now, another way of looking at this is by flows. And although you're seeing some retail inflows over at Bank of America, hedge funds and institutions, on the other hand, they've been selling. Really, it's corporate buybacks. They're really the main buyer here. So you are seeing some situation signals of capitulation. I'm going to do that slide again. From a market standpoint, we're seeing historical, let me restart this, slide 6. Now, from a sentiment standpoint, you're really seeing historic levels of fear or bearishness pop up. On the left-hand side, you can see investor sentiment has rarely been so bearish following a period of decent gains. It's quite incredible. Now, historically, when investors are this bearish in these conditions, it's actually a good contrarian signal. Another way of looking at this is by flows. And although you're seeing some retail inflows over at Bank of America, hedge funds and institutions, on the other hand, they've been selling, leaving corporations via buybacks really the main buyer here. So you are seeing some signals of capitulation. So let's move over to fundamentals. Now, if you want to be a bull, if you want to be an optimistic investor, you just have to sit back and say, A, there's no indication that corporate profits are headed lower, and B, you just don't get bear markets without profits falling, and usually they fall considerably. And we show here on the left, each bear market and their ingredients. Now, outside of crisis periods, it always leads back to rates crushing growth and profits. Now, on the right side, you see that the trajectory of profits today is much healthier than how it usually looks heading into or during a bear market. So either something has to break or is breaking, or earnings likely have to collapse for a meaningful, lasting downturn. And we just don't see that at this point. For us, one of the reasons we've been bullish over the intermediate term has been that earnings have been solid and broadening. On the left side, you see the trend of growth, but what's also important is the upside here to the expectations coming into reporting season. Large caps have been incredibly solid, but take a look at the improvement for small cap. That's a very encouraging sign for the segment that frankly needs it. Now on the right side, you see revisions are positive and they're heating up for some of those areas that have been left behind, like small cap again, and also value. Now, this tends to be a good leading indicator for performance outside of inflection points into recession or crisis. So if you don't think we're headed for recession, these areas that are seeing more significant earnings revision momentum could be in store for positive upgrades. So let's show some slide 9, starting that again. So let's show some, starting that again. Now let's look at some charts to illustrate the rotation that's clearly taking place. Now we've been bullish on the concept of domestic cyclicality, and it was working until it abruptly wasn't a couple of weeks ago. Now staples sharply turn the tide on discretionary. And then if you take a look at the insurance industry, it's really holding up financials overall because the cyclical banks are struggling on a relative basis. It's another indication that the market is concerned about growth and the delayed benefits of deregulation. Now, importantly, on the right side, you can take a look at some of these international trends. China's showing that it's not really a global rotation against tech, rather it's a U.S. rotation against tech. Meanwhile, Europe, remember, Europe is compositionally very cyclical to begin with. Well, Europe, of course, is outperforming the U.S. overall, but European cyclicals are also outperforming U.S. cyclicals. This is a telltale sign that the issue is within the concept of U.S. exceptionalism and not purely with cyclicality. And that gives us confidence that it's not time to fully abandon cyclicality. Rather, you want to recalibrate. I think that's a prudent approach, and that should come in the form of building on some of the defensive exposures like utilities, real estate, and pockets of healthcare. Looking at factors, you see another story told underneath the surface. We've shifted from durable leadership in growth and momentum to the risk-off exposure of lower volatility. Meanwhile, size does continue to be a winner. Let's start this again, slide 10. Finally, if we take a look at factors, you see another interesting story told underneath the surface. We've shifted from durable leadership in the growth and momentum factors to the risk-off exposure of lower volatility. Now, size, though, does continue to be a winner. The main observations here are twofold. First, it's likely prudent to take some chips off the table and exposures that ran up so far. The second observation is, if the growth scare proves fleeting, and that still is our base case, you could get a bounce back in leadership similar to what we experienced last summer. So I think that's what you're hoping for if you're a bull, and you don't want to abandon offense in that situation. So let's conclude with what we summarized up top. Yes, equities are grappling with a growth scare exacerbated by policy headwinds, and the off-road in this game of chicken may require a policy shift. But in the meantime, a shift from positioning to what we call a counterattack position is prudent. Let me start that again. Slide 10, starting. Finally, if we look at factors, you see another interesting story told underneath the surface. We've shifted from durable leadership in growth and momentum to the risk-off exposure of lower volatility. Meanwhile, size continues to be a winner. There's two major observations to be had here. The first is, yes, it's likely prudent to take some chips off the table and exposures that have run up so far. But also, if the growth scare proves fleeting, as is our base case, you could get a bounce back in leadership, momentum, and growth. Similarly, let me start slide 10 again. Finally, looking at factors, you see another interesting story told underneath the surface. We've shifted from durable leadership in growth and momentum to the risk-off exposure of lower volatility. But size does continue to be a winner. The main observations here are twofold. It's prudent to take some chips off the table in exposures that ran up so far, but also, if the growth scare proves fleeting, as is our base case, you could get a bounce back in leadership similarly to what we experienced last summer, momentum and growth. So I don't think you want to fully abandon offense at this point. So let's conclude with what we summarized at the top. Yes, equities are grappling with a growth scare exacerbated by policy headwinds, and the off-road in this game of chicken may require a policy shift. In the meantime, a shift to what we call a counterattack positioning is prudent. That would involve slight recalibrations within portfolios towards domestic defensive exposures and trimming some cyclicality. So on the margins, you may look to add a bit of exposure to real estate, healthcare, and utilities, and dial back a bit to industrials and even pockets of discretionary like retail, as we wrote about last week. So with that, thanks for listening. We always look forward to your questions and your comments. And in the meantime, stay active.